No way. It can't be this easy. The S&P is now within 1% of making a new record after an orderly 3-week pullback. Over in Germany, they're not waiting though. The DAX just closed at a new record high. And Wall Street has a new big bull, looking for the S&P to rise to 5,400 before the end of the year. And this week could get very interesting because OpenAI plans to announce Google search competitor on Monday. Whoa. But there's a few things under the surface which don't quite align. Look where we were a month ago. Look where we are today. That's the S&P. Now look at where the NASDAQ was. We basically fully recovered our last 30 days. But if we look here to fear and greed, about a month ago, we were sitting at 62, and the full recovery's not quite happened. So investors don't fully believe this move. But like I just told you, the DAX is at new record highs. The S&P is only 1% off, and we appear to maybe have some catalysts which could drive us higher. So with the biggest bull on Wall Street, what this really looks like is a Goldilocks report that pleased the Fed and the markets. Again, I just showed you we're within 1% of making a new record high, and conflicting economic data spurs swings across asset classes. Look at what Bloomberg said on the 4th a week ago. Souring profit outlooks threatens the S&P rally. Okay, well, 7 days later, or today, a week later, now they're saying that Wall Street is sending a bullish signal for the S&P 500 earnings. Man, they sound just like me. They're flip-flopping. And what's so interesting here about a Goldilocks report is that, man, we were even able to shake off the 1-month performance after ending a 5-month win streak, at least for now, where we're normally flat and normally 3, 6, and 12 months out. It's like 85 to 100% chance we're higher. Whoa. So is this going to be it? Remember, all we're looking for is for us to get back above 525 for the bulls. Pause the video if you want to read the notes we went over last weekend. And this really comes down to what you're going to regret more. And we've talked about this too. Many people are probably falling into bucket number 2 right now, but generally it's number 1. So remember, if you are an investor and not a trader, the stock market is a device for transferring money from the impatient to the patient. But whoa, what about the totality of the data? And that's exactly what Fed Chair Williams, Fed New York President Williams said. A Fed rate cut depends on the totality of the data, right? Made my joke for me. Thank you, Williams. And this will be important because Jerome speaks on Tuesday at 10 a.m. I'm not sure if he's going to talk about monetary policy, but these Fed officials have been coming out and really making a lot of headlines lately. If we look at the same headline here, again, Fed-obsessed traders are probably going to care what Jerome Powell has to say, and conflicting economic data. Well, man, 4.17% for GDP, that is red hot. That is so strong. Is that really what's going to happen? And the reason I say that is because if the economy, this is according to Joe, if the economy doesn't slow down, 2% inflation is extremely unlikely. Well, we're looking at 4.17 here for the second quarter. That could cause a recession because monetary policy is tight. Okay, so is it a Goldilocks report or is there a perfect storm? Well, as we know, we're looking forward to CPI on the 18th, which is what's really going to move the market this week, which has the biggest implied volatility. Okay, so Powell speaks on Tuesday after we get PPI, and then on Wednesday we get CPI, core CPI, and all that other inflation jazz. Joe is also telling us that he's looking for 0.4% gain on both. All right, so what would that mean? Well, that would mean that we're going to get a higher reading than we're anticipating. It was 0.4 last time for both. Now we're looking for 0.3. Is that going to cause the market to have a sour reaction? Remember, on Monday, we have OpenAI announcing a Google search competitor. On Tuesday, we got Jerome. And then on Wednesday, we got the biggest market moving event for the week. All right, now let's look forward to here. Lots of consumer stress masked by government spending. Is that really what that 4% is for GDP? Why? Well, because consumer sentiment tumbles as inflation fears surge. All right, seems like that Wednesday report's going to be really important. And the reason why I say this is because the Goldilocks is now becoming consensus, or what everyone's expecting. Just before we go further, I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would greatly appreciate that. Thank you ahead of time. So if consensus is now Goldilocks and we're within 1% of making a new high, and other major economies are already in new highs, what happens if we don't hold it? Well, that means that the market could be legitimately surprised. I also say that because if we look here to the VIX, it's now all the way down to 12. What does 12 mean on the VIX? It means no one's worried about anything. What could that mean? It means we're at risk of getting a shock. Could there be a shock? And I don't know. There's always the potential. I just showed you what I thought this could be. Ed Yardini says that won't be surprised if Fed starts talking more dovishly. That would be good for stocks and for bonds. It would give them a boost. All right. Whoa, whoa, whoa. What about the totality of the data? Well, again, I made the joke already, but there you go, right? Depends on totality of the data. And here's Goolsby, another Fed official, which is getting a lot of attention lately. He's saying something pretty dovish. Not much evidence inflation is stalling out at 3%. Kind of sounds like they want to cut. And they're in good company because we are getting closer to cutting interest rates, Bank of Canada governor tells MPs. This is from earlier in the month. And this week we heard from Bank of England Governor Bailey saying that they're moving closer to first rate cut since 2020. So this would be great because Powell would not go first, but everything appears to be in the Goldilocks area right now for both the Fed and for the markets. Okay, so what does that mean? Well, it means for other Goldilocks data, we look at what's happening for geopolitics. How Xi's Europe's trip is reviving continents. Right, there you go, the divide. Anyways, what he's doing is he's going in and trying to he had little success in driving a wedge between the U.S. and the EU, which is exactly what the U.S. wants. Here's a headline from Goldman Sachs' president talking about how the U.S.-China relation, series of engagements have been productive. Okay, this looks cautiously optimistic. And here, oh my God, read this, right? Putin says Russia is open to dialogue with the West. Whoa, that doesn't seem just like a Goldilocks for the Fed and markets, but maybe for global peace, right? It seems like there's a lot of things that are baked in now. So we can see here that he ends his tour with plenty of pomp and few concessions, brushes off trade practices and support of Russia. And again, this guy's like basically got his cap in hand. Please, sir, can you please give me some relief? And Jerome Powell might be really laughing here. Why? Man, things look so good. It looks like Goldilocks is here. And we talked about this last week too, where in the 1995 soft landing, the Fed cut then held for 3 meetings. Is that what they're going to do? Seems like they want to cut right now. And the rest of the world is eager to do it. Canada, the EU, the UK. Remember, when the Fed normally pivots, if this time's really different, well, we're not going to see a nasty drop. -30 to -50. Whoa. But remember, we talked about this last weekend too. In 1995, they did cut, then they paused for a while. The big one came 4 years later in 1999. Do you want to be wrong for 4 years? Well, again, because we're so close, we're within 1%. If we manage to break higher, man, bull break. Who's going to deny that? It's not me. And Jerome Powell's probably laughing all the way to the bank. There's a few more earnings this week, but I don't think they're really going to be market moving. What I'm really focused on is whether we get a blow-off move into Monday with this OpenAI hype, and then whether or not we actually see these things actually pick up, meaning the S&P, the NASDAQ's already moved higher. Well, is fear and greed going to actually give us that momentum? Remember, Stanley Druckenmiller this week told us that AI might be overhyped in the short term, but underhyped in the long term. Hey, we're going to find out. We're going to get a big test on Monday. So looking at a few more key charts just to keep the video really simple. When we look here to the S&P, what I'm noticing is that we have a megaphone, and it looks like this was a trap. I say that because we had a violation, but then that was only for one weekly candle close. If we look here to a line chart, what do we know? Dip and rip or a V recovery, right? Get below the uptrend, trap the bears. Man, snap back. We're going higher. We have a gap on the chart here, though. So if we go higher to a new all-time high, then fall below, that would be a failed breakout. Watch for strong support on the gap fill, which would also correspond with the uptrend here. Otherwise, this megaphone pretty much gives us the trajectory that if we're going to go to my target of 460, man, look at that. Is that going to happen? That would be incredible if we maintain this uptrend, which is right here, and we're looking for 560 to hit. That could be here for September. It's right before the election. Whoa, really? Yes. If we look here to the NASDAQ, this looks like a back test of our previous top and a pass, at least for now. Again, I told you that we're really close to that monthly high, and volume is not really that impressive. The biggest bars here are largely red. Looks like a lack of sellers rally. So if buyers don't show up, are we going to stall out at the all-time high? We're within 1%. Or are we going to do what Germany did and just blow higher? Volume's a lot better here, but the biggest bars are still red. So is the US the same? Hey, we're going to find out. Make sure you subscribe to the channel if you don't want to miss a video, and I'll update you on all of these this week. Looking at a few more quick charts here, looking at the dollar, this one has me a little bit uneasy. And I say that because I notice a cup with a handle, And if we break over 106.50, we're probably going to go up. Right now, the rest of the world is talking about cutting. So if Jerome says, actually, no, we're not going to cut, right, the totality of the data, I think that the dollar might break out and add more pressure to stocks. We know we're already going higher. We got a golden cross. Let me just go back here. So if we delete everything, we got a golden cross. We're now back over the 50, bounce, higher, low, bounce, higher, low, bounce. All we got to do is break out. We've already stopped going down. We're pointing up, and that's usually bad for stocks. Looking at two more quick charts, like I mentioned, the VIX. VIX is now below the teens. It's at 12. That's not in the teens anymore. What does that mean? No one's expecting any volatility. What does that mean? We're at risk of volatility. I know that sounds counterintuitive, but when do you buy insurance? Well, you generally don't want to buy it when you need it. Why? Rates go up. You want to buy insurance when you don't need it. Maybe something you want to consider doing now. And if we look here to the 10-year note, this is the one that also gives me a little bit of unease here. The last three charts. So like I said, S&P looks fine, right? It's within 1% of all-time highs with a megaphone higher. It's got a gap on the chart. We got support if we hold that gap fill. NASDAQ's really close to all-time highs too, right? Within 1%. But these charts tell me that if they break out, there's going to be pressure. Something's got to give. I'm not sure what it's going to be. The VIX is telling us that people are complacent. And then finally here on the 10-year note, if we make this really simple, we have this neckline right here. And what used to be resistance is now acting as support. So we don't really see that head and shoulders pattern that the bulls would have liked to see, which means that bonds go down and stocks go up. Again, that was the quote we talked about where if the Fed starts talking dovish, we should see these lines go down or we should see TLT go up, which is inversely correlated to yields. And we're awfully close to breaking out here. So what's going to give? Well, stay tuned and watch the video on the left if you want to see more. If not, subscribe on the right, and I'll see you at 9:15 and 9:30 a.m. on Monday. Thank you very much.